We're here to talk about Silicon Valley real estate market on the week ending June 6, 2025 at midnight, presented on Saturday morning, June 7th. These are the key chapters you can go over, and these are the graphics that correspond to them. The timestamps are in the YouTube description below. First overview slide is simply the number of transactions we have. Here you can see that we're on a weekly basis, and this is delayed by 1 day. Instead of my Saturday through Friday week currently, this data is from a Friday through Thursday week because otherwise the late reports that happen on the last day are so significant the data wouldn't be comparable. So I delay this by 1 day, but you can see we have fewer offers, or right at the fewest number of offers you'd expect. And we've been that way for the last year and a half. So it's not that we've had a huge drop anytime recently in the volume of transactions. Here's an overall summary. Basically, the stuff left of the center of the graph that are highlighted in the green here are comparing the indicator to the 10-year median. So basically what you're seeing here with the amount of blue on here is it's saying that you have a lot more conditions that are favoring the buyer. In other words, each condition that's blue is conditions favoring the buyer more than it typically does based on the 10 years. Here now is the current market indicators, and that's pretty balanced. So even though this favors the buyer here, which simply says the market is worse or favors the buyer more than it typically does, we still have a pretty aggressive marketplace. For example, in Silicon Valley, you'd sell out your existing inventory in less than 50 days, or just over a month and a half. 3/4 of the sellers are selling in 27 days. That's 4 weeks. The typical price reduction is only 1.2%. Less than 1 in 5 sellers reduces their price at 18%. So these are still a strong marketplace. It's just Silicon Valley is normally stronger or faster. The overbidding is a lagging indicator in the orange, and then appreciation, just red is simply those that are areas that have the highest appreciation. And then on the price, I have the median that most people only follow, but I throw in the 10 percentile and the 90 percentile, so it's sandwiched so you know a price range in each area. Here now is the key indicators. Here, what we're doing is the gray line is where you'd expect the data to be based on the previous 10 years, comparing the same week. The middle of the graph right here is this week. I go back 13 weeks, a full quarter, and I go forward 13 weeks. Obviously, I'm not projecting the data, but this gives you an idea where you'd expect the data to currently go. If it's up on the blue line, you'd sort of expect it to continue to follow the blue line. If it was on the red line down here, you'd sort of expect it to follow the red line. So it just gives you an indication. This is where you were 13 weeks ago with 2,000, 2,100 listings, and that's 17% more listings than you normally expect. Now we're at 3,200, so we have another 1,100 listings. That's almost 50% more, but it normally grows. So even though it's 50% more, we've only gained to 25%. So we've only gained something like 8% of your inventory. So the relative gain, the raw count gain is huge at this time of the year, but the relative gain compared to what it normally gains is actually fairly small. Now, offers accepted is different. You went from basically 89% down to 81%. So your number of offers accepted went down, even though the raw count went up from 1,900 to 2,300. So your number is increasing, but not increasing as much as it normally would, causing the percentage of the normal to drop. Then we have the number of transactions. And this is actually interesting when you look at this. You went from 88% of the transactions you'd expect, which are closings, which is very close to the 89. So the offers and transactions were very close together just 13 weeks ago. Now there's a 6% drop difference versus a 1% difference. So there's 5%, 5 times more discrepancy than there used to be. How can I explain this? Either escrows are taking longer time to close all of a sudden, or more likely the number of transactions that are failing has increased to explain the lower number of closings. What are we closing? We're closing 2,100, which is just a little bit more than 2,000 you'd expect with the fewest. Days on inventory, the seller-buyer balance, you can see that it's slower than you'd expect it to be up here, and quite a bit slower. And in terms, we're now at 48 days. Slowest is up here at 40. It's a whole week slower than the slowest you'd expect it to be. But I maintain that for selling out the whole inventory in basically a month and a half is still a fast-paced marketplace. So yes, it's slower than you would expect for Silicon Valley, but it's still a very respectable turnover rate in the marketplace. We'll see that again here on Days on Market. This is how long is it taking three-quarters of the sellers to sell. A quarter ago, it was 14 days. That was 57%. So it's actually faster than you'd expect. And you can see that the purple line down here is below the red line. So it was faster than a fast marketplace. And the major reason for the huge difference from where we were to where we are now is the fact that the decrease in days on marketplace happened much earlier this year than it typically does. And we'll see that in a couple slides. But we're currently now where the typical seller is selling out in 27 days, in 4 weeks. So three-quarters of your marketplace is selling in less than 4 weeks. That is still 60% slower than you'd expect. And it's actually half a week, so 4 days, longer than the longest you'd expect. You'd only expect it to take 23 days, and you're actually taking 27. Price reductions. This now is the average price reduction, or it was only half 1%. And that's actually 35% larger price reductions than you'd expect. And that's one of the reasons I don't like the average is it's such a small number. And that's because the vast majority of the sellers take no price reductions whatsoever. Now we're at 1.25% price reduction, and that's 2 times what you'd expect. You'd only expect a half of 1% price reduction, and you're up here at 1.2%. So sellers are clearly taking more price reductions. You can see right here. But again, there's been this shift in time where the decrease that we're having now looks like it happens in a couple weeks typically, or it's going to start happening next week. So unless we continue to decline, we're going to catch up to where we normally are, and these percentages will decrease. Overbidding, we got to wait for escrows to close, so it's actually a lagging indicator. A quarter ago, we were at 8.5% overbidding, so sellers were getting on average 8.5% more than their ask price. Typical is only at 5.4%. So you were clearly seeing you were getting 3% more overbid. 3% of $1 million is $30,000, so it's not insignificant. Now you're at 7.8 typically, so you've come down a little bit, but we're actually at 5.5, so we've come down quite a bit. So now we're below the typical line and we're approaching the blue line. Here now is looking at the three key indicators over a long period of time, going all the way back to January 1st, 2015, up to January 1st, 2024 is on a condensed scale, and then an expanded scale for 2024 and 2025. And that's so you can see the characteristics of the cycle that we see better. Over here, it's too condensed, but I wanted to give you all 10 and a half years worth of data. So let's look at inventory. Inventory is the purple line, and we're up here at about 25% more inventory to expect. You can see that we've come down. We peaked at about 38%. So maybe sellers are starting to realize that this isn't necessarily the best time in Silicon Valley to sell their house, and maybe they're holding off. But you can see that we've improved slightly, or we have now less inventory than we did just a few weeks ago. Looking at offers in the orange, you can see offers are down around 82% of where they would expect to be at this time of the year. And that's actually been improving for the last couple of weeks. So inventory is getting less, and offers are increasing, causing DUI to fall. And it's fallen from basically 72% more longer time than you'd expect, now down to 44%. That's actually a fairly significant improvement. But notice it's still at a record slow number. Yes, there's a little tiny period right here in 2018 where it was higher. So shelter in place was obviously higher, and you got a little period of time right here in 2022 in the middle of our price decrease where it was at the same level. So days unsold inventory is still slow compared to where Silicon Valley normally is. Here now is looking at Silicon Valley, Alameda, San Mateo, and Santa Clara County in a blender. Where's your inventory? You can see you went from a quarter ago, or at the beginning of the year, from the least inventory you'd expect up here at the end of first quarter, you're already at the most, and we've maintained that most. We exceeded it, with the recent improvement, we're down and slightly this week, just slightly below the blue line. But you're essentially following the blue line. You're not going to have an exact match. So you have more inventory than you'd expect, but not outrageously more, but still more than you'd expect based on the past 10 years. Here's on a percentage basis, and you can see that right at the end of 2018 and beginning of 2019, there was more inventory, but that's all. But at this time of the year, there's limited inventory, well, especially at the end of 2019. By now, you're the same level here and halfway through second quarter, which is the same we're here, and we're basically at the same order of magnitude. And I would suspect that most people really didn't notice the slowdown at the last part of 2018 and early into 2019. But that's the kind of slowdown that we're currently experiencing. It's basically, in my opinion, right now, just a normal market correction. Here now is the number of offers accepted. You can see the number of offers accepted is above the blue line. It went down this last week, but it's still keeping its distance at somewhat above. The real takeaway is we've had a lack of offers all the way since basically halfway through 2022. Early in 2022, the market was on fire, and right around, and we can debate when it happened. Most people would probably say by April, but I'm saying the data started changing way back at Valentine's Day. Offers accepted is a lagging indicator because you have to change seller and buyer's perception, and that happened clearly starting right here at the beginning of second quarter. But anyway, we've had this lack of offers accepted for a significant period of time now, and that's going to actually change my 10-year data when this starts becoming the majority. But that's going to be a couple years down the road. So clearly a lack of offers compared to where you'd expect it to be. Here's on a percentage basis, so you can see that basically for the last year and a half, we've been at about 80% of the offers you'd expect. In 2023, we were probably down at 70%. So we've gained back 10% of the marketplace, but we're not up here at 100%, and we're clearly not up here where we enjoyed 120% of the number of transactions shortly after pandemic when interest rates were low and everybody's housing needs changed. Here's the days on unsold inventory. You can see that you're significantly above the blue line on a percentage basis, and that's this graph here. So when you look on a percentage basis, DUI is basically still very slow, and basically record territory slow for all, or tied for records. Here's marketing time, and here you can see the time shift. Here is where the gray line, typically middle of first quarter, you can see it turned around and came down normally. Here it turned around right at the end of last year and came down. So this steep decrease in days on marketplace happened a half a quarter earlier, and then the valley normally happens halfway through second quarter. It happened already here. So we may end up not so bad at the end of the year. I've never seen the time shift like this before, and I'm not sure I understand why it happened. It clearly happened. It would suggest that inventory was flooding the market before the buyers were. Normally, the buyers come on the marketplace first, but you had to have a flood of new inventory with 0 days on the marketplace that buyers were then snapping up as quick as they could. It happened. The reason behind why it happened, I don't know. I report on the market conditions as I see them based on my data. Here's on a percentage basis, so you can see halfway through first quarter, we were at record low numbers. This is all 10 years. The only time that was the same magnitude was here right before the market crashed in February. And this is a good indication of why I say Valentine's Day, middle of first quarter 2022, it started climbing. You had the same thing here, middle of first quarter, it still climbed, and we climbed more than we did in 2022. So, 2022, not the slowdown occurred, but was accompanied by fairly significant price reductions. We have not seen those price reductions yet in Silicon Valley, which is sort of interesting. So the drop here is more significant than the drop in 2022, but we're not seeing the associated price drops. Here's the seller's price reductions. This is the largest. This is essentially the 90th percentile, the largest 10 percentile of the sellers. They're taking a 12.5% price cut right now. 12% would be here at 88%. This is about 87.5%. That's off of 100, so it's about 12.5%. That is basically below below the most you'd expect them to be doing, which is somewhere up here around 11%. So they're taking an extra 1.5% price reduction. On a percentage basis, you can see you're up here in fairly rare territory. Yes, in 2022, there was more price reductions, but that's what I'm saying is we're not seeing the huge drop in price that we saw in 2022. Here's the average. I put this in, not that I actually sort of dislike this because 80% of your data is typically zero and it just makes it a real small number, but it's here to show you that I'm not misrepresenting the data with my 90%. Here you're seeing the average seller's only taking a 1.2% price reduction, happens to be 1/10 of what the 90th percentile happens to be. Just coincidence. But you see where you typically are up here somewhere around 8/10. So you're still taking that 50% more price reductions. Here, again, on a long-term basis, you can see you're in record territory. And when I say record territory, you're not at the record high, which obviously would have been back here in 2023. But there's not much calendar time frame where you've had this kind of price reductions. And it was actually higher just a few weeks ago, right at the end of first quarter, beginning of second quarter. Here now is the frequency of price reductions. So you have something like only 18% of the sellers taking price reductions. That means 82% of your sellers aren't adjusting their price at all. And this is for all of Silicon Valley, and it's slightly more than the most sellers that you'd expect by about 2% or about by 1% more. But the big change is you'd only expect about 10% of the sellers taking a price reduction. So it's almost 80% more than your 10% to get to 18%. And that's how you can say anything you want with statistics. Here you can see you're in fairly high record territory. You're in competitive high territory. You're not at the record high, which is right here in early 2023. But, there isn't much time. There might have been a year here and a half a year back here. So except for a year and a half out of the last 10 years, you're at record high territory. Here now is looking at the overbid. I do need to caution this is median, and it also lags behind because of the length of escrows. I forgot what the average was. I think the average was up around 5.5%, but you can see the median is down here at about 2.5%, 2.75% overbid. So, and it's still above the least you'd expect, and it's significantly below the gray line, which is what you'd expect. The gray line is coming down, and again, it's almost like this time shift has happened earlier in the year. Again, on a record basis, except for about 15 months out of the last 10 years, this is record low number of overbid. So you're still overbidding, but it's 2% below where you normally are. So if the overbid was, call it 3%, normal overbidding would have been 5.5% typical overbid. Here's the frequency of that overbidding. Right now, only 64% of the sellers are getting more than their asking price. At this time of the year, it's typically up here somewhere around 75% of the sellers are getting. So again, it's lower than it typically has. But if you look at it, the turn in the marketplace happened right here about where it normally does. Here, there's already been a shift. So days on market shifted at the beginning of first quarter. Now the frequency of overbidding is shifting to the left or earlier in the year at the beginning of second quarter. Again, no explanation of why. Here's the frequency of overbidding compared to normal. So you can see that we're only having about 85% of the normal overbidding. And again, you had a period of time when it was less right around 2023 and again in 2019. Here now is a pricing. I have two pricing. One is long-term, where you just say you've had an 11.4% price appreciation, or another one is where you divide it in half and you have 12.5% for basically, I think it's 7 years, and then 3.3% for about 3 years. Either way, you get to the same number, and you can see that prices have come down a little bit here. They've rolled over, but if you come back to 2022, look at that price decrease. So, we haven't gone far enough down. And if you look at it, the price decrease here is roughly the same magnitude. So are we going to start seeing this huge cliff off? And, stay tuned. We'll find out together. And not in this episode, because there's no way to know what's going to happen over the next 6 months. But after you continue to join me for 6 months, you'll start seeing, is this price adjustment going to continue to come down? Here now is looking at distributions. Each line on here is a week. I start off and have every week initially because that is the trend you'd expect the current 2025 data to go. The dotted line is a year ago data. And then after about a month, I jump to every 2 weeks. So we want to have every data point. But here's the current line, the purple. So you can see that marketing time is clearly longer than it was a year ago. And we'll start stepping through. And you can see that the dotted lines were starting to climb immediately. So you'd expect that purple line to continue to climb upwards, is what you'd expect. Now you're getting down to what I call the Halloween timeframe, and now the end of the year run up. So there's the slowest right around December 27th, the rapid appreciation. There's the peak right around February 21st. And again, I only have data for every other week, and you can see the solid lines are climbing up to the current purple line, which is coming up pretty soon. There it is. So I'd expect the purple line to continue to climb and get longer and longer days on marketplace. But you can see again where we were a year ago on the dotted line down here. And you can even see where we were on the solid lines. We got all the way down here. And in fact, the yellow line right here is our best line for 2025. Best line ever is down here where you had very rapid time frames. And you can also notice how steep, when the market's improving, how steep this high end climbs up. And then as you get to the bottom and the market's climbing, the high end stays low. It's just because these are sales that are happening for properties that have been on the market for a long time. So there's a few of them, which is what causes it to go up. Once everything's cleared off your shelf down here on the yellow line, they all go up at about the same rate, which is why it flattens out. So if the market was to start improving, one of the key indicators is this high end here starts climbing relative to the rest of the line. So you can keep an eye out for that kind of characteristics. Here's now as the largest price reductions. And the same concept. Here's where we were a year ago, where the sellers were taking significantly less price reductions. And you can see that only 12.5% of the sellers were taking price reductions. Now more than 17.5% of the sellers are taking some price reduction because we're not up here to the 100%. This is one of the few times where, it might make sense to expand this graph, but you can see the vast majority of the lines are hitting 100%. And I like to see where the line's moving, and that's why I did it. So let's step through. You can see that the price reductions increased and it bounced a little bit. So this is sort of the summer where it just bounces around a little bit each direction week to week. And then right around Halloween and Thanksgiving, you'll start seeing a slowdown right there, November 29th. There's the peak of the marketplace right around January 1st. There's the hottest marketplace, and that was something like February 21st. Here's the solid lines. You can see you're still getting slower and slower, more and more price reductions. And now we're current week. So we're nowhere near the worst week we had, which was basically December 27th, 2022. But we are having more price reductions than we did a year ago. And the last distribution is competitiveness, which is buyer overbidding. And so again, the same concept. The dotted line is where we were a year ago and where we're going to start off. The purple line is the current data. So let's step through this. So you can see that the dotted lines are getting cooler, less overbidding. Now you're sort of, and this peak is or down step is going to be closer to Thanksgiving because of the time lag. So right about there, there's the bottom of the market, January 24th, and now you're improving, more and more overbidding. We're right there at the peak already. We're sometime in April, I think it was, and now you're slowing down to purple, which is right there. So you're clearly having less overbidding than we did just a year ago, but we're well within the lines of the most competitive overbidding we've had and the least competitive overbidding we've had. Now we're looking at the three counties compared to each other. Santa Clara County is in the blue, Alameda County in the gray, and San Mateo County in the orange. Right off the bat is notice San Mateo County is in an all-time, past 10-year all-time record high level of inventory. It's above 600. You can follow the gray line back, and at no time was it at 600. Really, the highest it really got was 550. and you're now above it. So you have almost 10% more inventory than you ever have had for San Mateo County. So San Mateo County has a lot of inventory to pick from. So if you're looking at in San Mateo County, you might say the market has a lot of inventory. If you're looking in Santa Clara County, we're only at 1,200. Clearly, there was time frames here where we had more than 1,200, and we were at 1,550. So we actually have 350 less homes than we typically do. And if you look at Alameda County, it's right about where it used to be before the pandemic. So Alameda County is sort of normal. Santa Clara County's got a shortage, and San Mateo County has a surplus. So even the three counties that make up Silicon Valley are not behaving the same. Offers accepted. Now, Alameda County and Santa Clara County have or almost exactly the same number of offers accepted. Santa Clara County had less inventory, so it's going to have a faster turnover rate than Alameda County. San Mateo County is down by itself because it's a smaller county. But right here, you can see that the offers accepted are nowhere close to where it normally is. So San Mateo County will have one of the slowest marketing times. And here's marketing times. San Mateo County is actually in second place. Alameda County was actually slower. So even though it didn't necessarily look like that, when you look at the actual numbers, you get that. So Alameda County is the slowest marketing time, the longest turnover rate. Santa Clara County has the fastest turnover rate, and San Mateo County is in between at 50 days. Here's marketing time. Now, this is sort of interesting. The orders is the same. So Alameda County has the longest marketing time at 30 days, a full month for 3 out of 4 sellers to sell. San Mateo County and Santa Clara County are very close together. If I had to call it, I would say that San Mateo County is at 28 days and Santa Clara County is at 27 days. So basically both right at 4 weeks. Here's price reductions. Alameda County is doing the largest price reductions. That sort of makes sense. It's got the longest marketing time, more time for sellers to take price reductions. Santa Clara County and San Mateo County are pretty close together, but Santa Clara County is the second, and San Mateo County, with its second place, has the least. So it's got a surplus of inventory, the second slowest or the middle turnover rate, but it's got the least amount of price reductions. Frequency. Alameda County's got the most frequent price reductions. Santa Clara County is in second. San Mateo County is in third. So I'm trying to point out that the orders are not necessarily what you would think logically they would be in. And here's where they really stick out, because Alameda County, that has the most price reductions, the longest marketing time, actually has the highest overbidding, and by quite a bit. It's at 7% overbid. San Mateo County is only at 5%, and Santa Clara County is only at 4.5%. So the county with the most price reductions has the most overbidding. It just doesn't make sense. Why? Well, the logical explanation is sellers are doing those price reductions, those frequent price reductions, overshooting where the market is, and then the buyers are coming in and overbidding the seller's new list price that's been lowered, because this is based on the price at the time the offer is accepted, not the original list price. Here's the frequency of overbidding. All three counties are very close together. It's somewhere around 64 to 66% of the sellers are getting more than their asking price. So just under 2/3 of the sellers are getting more than their asking price in this marketplace. So if only 1/3 of the sellers are getting less or equal to their ask price, how can we say this is a terrible marketplace? Here's long-term appreciation. Santa Clara County really stands out with about 125% appreciation. Alameda County and San Mateo are together at about 82% appreciation. Here's the price. Santa Clara County on the blue is above Santa Mateo County in the orange. And then Alameda is the more affordable at about $13.75 on their price. Here's the same information paper, and you can see that Alameda County is actually closer to $13.50. You can see that Santa Clara County is about $21.50 and San Mateo County is about $2,100. Here's estimated payments using the Freddie Mac high balance conforming loan limit interest rate, which is higher than if you went out and got a jumbo loan. So your payments here are going to be slightly higher than you could get. And Also, a lot of people who are going to be putting more than 20% down. Others are going to have retirement funds that they can get relationship pricing on their mortgage from their financial institution. You can see Alameda County is the most affordable at a $10,000 a month payment and $16,000 essentially for San Mateo and Santa Clara County. Here now are my micro market areas. Here's the active inventory. You can see that pretty much across the board, we're either white in color or blue. I would say it's mostly blue. The one exception is the small area in Foster City, and it's such a small market area with such little inventory that it flip-flops quite a bit from week to week. Here's offers accepted, again, mostly blue in color, which says you're missing inventories. It favors the buyers, so lack of offers. And here's your percentage of Foster City. It's the only one at 100% or above. Oh, I take that back. Los Altos, Cupertino is also there. Los Altos, Palo Alto at 10%, 9% above. Cupertino, Sunnyvale at 2% above. Everybody else is below where you'd expect it to be. Here is the days on unsold inventory. You can see Foster City again is the holdout, and I think that's because of the lack of inventory. But again, mostly blue in color. A few areas that are white or normal in marketplace. Again, Cupertino, Los Altos are fairly normal. Even Cupertino isn't that normal at 14%. That's starting to be a shade of blue in there. It's hard to see. But when you have a higher percentage, you tend to get bluer in color. In fact, up here is your benchmark from 114 to 200% is when you go solid blue. So only Morgan Hill is solid blue. East, the affordable areas is close to solid blue, but there is still more room. Here's now marketing time, very blue in this one. So it's taking longer, significantly longer for 3/4 of the sellers to sell their property in all areas. And that's compared to the 10-year median. Here is the price reductions. Again, you can see that most of the areas are blue in color. The exceptions are the coast, which is sort of interesting because it was slow. And right now, Atherton, Menlo Park, the expensive areas in San Mateo County. Here are the frequency of price reductions. You can see that along the affordable areas where you're having the most price reductions, the peninsula is actually having the least amount of price reductions. Here's days on unsold inventory, and this is just raw numbers. So this is where I start trying to balance things out a little bit. And I'm not trying to paint the market as rosy, but to have your entire marketplace turn over every 6 weeks is a fast-paced marketplace. And anybody that's red in color is turning over in 6 weeks or less. Now, once you're up here in the blue, you're 11 to 20 weeks. So that's clearly a slow marketplace. But a good part of Silicon Valley is turning over pretty rapidly. Here's marketing time. This is more balanced, and balanced is 3 to 6 weeks. So white in this time frame is 3 to 6 weeks to sell 3/4 of your inventory. If you're pink in color, you're less than 3 weeks. So a good part of Santa Clara County is still selling in less than 3 weeks. Here's the price adjustments. Here's where it's a tight metric, and this is the average ask price, since more people like that. But it's a very tight metric. So you're blue, a very shade of blue, which means you're 1/4 to 1% price reduction would be white. You're over 1% if you have any blue. Here's the frequency of price reductions. So red is low price reductions. So this is favoring the seller, very small price reductions. The more affordable areas are where you're having the large amount of price reductions. Here's buyer overbidding across the board. Buyers are still overbidding. When 2/3 of your sellers roughly are getting overbids, you can't complain. And this is magnitude. So, what are we getting? We're Santa Clara County 4.3%, Santa Mateo 5%, Alameda County 7%, overall 5.5. If you're getting more than your ask price, how bad can the market be? Here's the frequency, and this is where I jumped the gun a little bit. Here, roughly almost 2/3 of the sellers are getting more than their ask price. So that, of course, that's going to be a hot marketplace. Here's appreciation. You can see that San Mateo County's got some blue. It's also right now got some bright red here in Atherton. Palo Alto, though, its neighbor in Santa Clara County is blue. So it's sort of interesting. A lot of people want to group these two marketplaces together, and one's on fire right now. This is the number of offers that have been accepted in the past 5 weeks. You can see this year we're at 2316. In 2020, we were at 2302. I suspect that within a couple weeks, this 2316 will drop down below the 2302 and will become the third worst year in the last 10 and the last 20. Right now, we're the fourth. There are 4 years, 2023, 2024, and 2020. So 2023, 2024, and 2020 all are worse years than us. So there's 3 slower years, but they're all fairly close together. The lowest year was 2150, and we're only at 2316, and I expect that number to drop. So we'll be within about 10% of our lowest number of offers accepted. Here's the actual numbers for Silicon Valley, Santa Clara County, San Mateo, and Alameda counties. You can see the number of new listings is down. The total inventory is basically down because of Alameda County. Offers accepted is down mostly because of Santa Clara County. Days of unsold inventory is increased, although I will point out that it did decrease in Alameda County. I have the median, average, and 75 percentile days on market. So here's one location where you can compare the three numbers. And if you're looking at the median days, to sell half your properties in 11 days in Santa Clara County is still a fast-paced marketplace. And it takes 18 days to sell the average home, and it takes 25 days to sell the 75th percentile. So don't confuse my 25 with either the average or the median, because there are three different numbers. I'm using the 75th percentile because I want to get up on the curve and have more movement. Then you have the list price reductions where you can see they're just over 1%, 1.2% for the valley as a whole. Overbidding is median is 3%, average is 5.5%, and 64% of the sellers are getting more than their ask price. You have 97%, 98% appreciation for Silicon Valley, with Santa Clara County having a notable 124. Then your price ranges of 10, median, and 90 percentile. And then the appreciation since 2020. So you have the appreciation since the pandemic, as well as the appreciation long-term since 2015. We have been talking about the Silicon Valley real estate market. We will be talking about the Greater Bay Area, 13 counties and 5 regions. Appreciate subscriptions if you're not already a subscriber, as well as likes. If you want to look at a YouTube archive of the presentation, you can type in the long blue YouTube link, or you can type in the shorter tiny URL link, which I call the green root URL. To get to the live presentation Saturday morning at 9 a.m., you just type in the green root URL plus the year 2025, and here's the meeting code if it asks for it. The handout is up. I made it right at my 15 minutes before the hour target. That URL is the green URL plus the letter H 2025-06-07 for today's date. And any specific episode you can get there by typing in the green root URL plus the year, month, date code. I'm Richard Calhoun, real estate broker with Creekside Realty, working with buyers or sellers. And one of the unique features I offer buyers is commute times and school performance information from great schools, along with the listing summaries and direct links to details. So reach out to me if you're a buyer that is of interest to you. Now moving on to the Greater Bay Area, these are the 5 regions. We've already been talking at length about Silicon Valley. We add in the city, San Francisco and Marin, the North Bay, 4 counties, Central Valley, 2 counties, and the Central Coast, 2 more counties. This is for single family and duet homes. Here's your active inventory. Active inventory is increasing in all the regions except for Silicon Valley, where it's flat, and except for the cities area. So the more closer in job site focused on the high tech is basically flat on inventory. The more outlying areas are still increasing, but all the regions are increasing at what I would say is a slower rate than they were just a couple weeks ago. Here's the offers accepted. Offers accepted is increasing in all the regions except for Silicon Valley. Took a little bit of a dip this week. Central Valley is close to being flat. The other 3 are clearly still up. Days of unsold inventory, the slowest area for turnover rate is the Central Coast at just shy of 100 days, of something like 96 days. The fastest is Silicon Valley at something like 48 days for Silicon Valley, and the cities is somewhere around 55 days. Central Valley is at 75 days. North Bay is at 80 days. Marketing time, this is my 75th benchmark. So the longest marketing time is the North Bay at just shy of 50, probably 49 days. Then you have the Central Coast and also the Central Valley, both at 42 days. The cities at 34, and the fastest area turning over is Silicon Valley at 27 days for the 75%, three-quarters of the sellers to successfully sell their property to sell. Here's the ask price reductions. You can see that they're average, fairly small numbers. Silicon Valley has the least reduction at about 1.2%. Cities about 1.4%. Central Valley and North Bay tied at about 1.7%. And the one with the most price reductions is Central Coast, approaching 2.2% price reductions. Here's the frequency of those price reductions. You can see that the cities and Silicon Valley are tied for the least at 18% of the sellers are taking a price reduction, so that's less than 1 in 5. Then close together at 26 and 28% is the Central Coast and the North Bay. And the area that's having the most price reductions is the Central Valley at 34%. So more than 1/3 of the Central Valley sellers are reducing their price. But keep in mind, here at the peak, the Central Valley basically only got up to 52%. So 34% is getting to be fairly high, although the Central Valley tends to be on the high side along with the Central Coast, my two centrals. Here's the magnitude of overbidding. This is a lagging indicator because you need close of escrows, but basically the trend is downwards. I will point up the North Bay did jump up this last week, but it's been on the downward trend. So the magnitude of overbidding is down in probably all 5 regions. Is probably the most accurate way to summarize that. Frequency of overbidding, how common is it? It's becoming less common in all areas, cities, and Silicon Valley has the most common overbidding on each side of 2/3. Then you jump all the way down to less than 50% in the North Bay at about 43%, Central Valley at about 38%, and the least amount of area is just shy of 1/3, with Central Coast being at 32% of the sellers getting more than their asking price. Here's the long-term appreciation. You can see the cities has done the least well since the pandemic, and Silicon Valley has done the best. Central Valley and Central Coast are pretty close together at about 90% appreciation, and in between is the North Bay at about 72% appreciation since the last 9 months of 2015. Here's the sold prices, and again, a lagging indicator because you have to wait for escrows to close. Cities is the most expensive area, followed by Silicon Valley, Central Coast, North Bay, and the most affordable being the Central Valley. Here's the monthly payments. They're going to be in the exact same order because they all go through the same formula. I use the Freddie Mac high balance conforming loan limit interest rate for the nation, which is higher than you can get jumbo money. So someone that's doing an 80% loan without a discount would be lower than this. And then if you have relationship banking using your IRA retirement funds or anything of that nature and get relationship pricing, you'd even have a lower interest rate and therefore lower payments. Here's the raw numbers for now is the current raw count. The next column, 1 week, is basically the percent change from just last week. And then 5 week is the change from 5 weeks ago in each one of the metrics. And we're back to the chapters that you can jump to using the timestamps in the YouTube description below. I'm not seeing any unmuted mics, so have a great week. Take care. Bye for now.